are on their longest winning streak since 2004, with company debt rallying for the fourth straight quarter. But as the global economy continues to show signs of recovery, is there still good value to be had? Joining me now is Matt Freund. He's Vice President of Fixed Income Investments at USAA. They have approximately $70 billion in assets under management. So, Matt, there's been sort of a debate now over how much further this corporate bond rally can go. You actually think that it's still a good place to put your money right now?
Well, I do. I think when you look at the corporate bond market, folks who look back and see the tremendous returns that we've had over the last year and a half are a little bit concerned that it can't go on. And I think that their concerns are justified in that capital appreciation. So we've had some of our funds here that were up 25 and 30% on the bond side. That's unlikely to continue. But I think bonds are going to return to their traditional role as income accumulation vehicles. And when you look at the yields that you can get in corporate bonds today, certainly compared to a very modest inflation rate, I think your real returns are still rather attractive.
Now, there's been a lot of talk about the government ending its purchases of asset-backed securities and the effect that that's going to have on the corporate bond market. There's been some dire predictions there. Do you think that that just won't have a very large effect, or do you think that it's been overstated, perhaps?
Well, that's a great question, and unfortunately the answer is no one knows for sure. On the one side, we know that one of the largest purchasers of mortgage-backed securities, and by the way, it wasn't just mortgage bonds, it was treasuries too, is going to be stepping back. Now, that's been known for some time, and the government's actually been tapering down its buying program. So the last data I saw was they were buying between 40 and 50 billion, which is still a pretty big number. On the other side, you've had some changes at the agencies where they've actually pulled delinquent mortgages from the pools, which is causing some reinvestment demand. And then you have a tremendous amount of cash sitting in money market funds, earning just a couple basis points. And that cash is beginning to be redeployed into the longer-term parts of the bond market. So there is a pretty good, some pretty good sources of demand going forward.
It seems, though, from what we've seen, for instance, from bank earnings recently, that fixed income already has proven quite popular, and investors who we surveyed on by the same token are saying they didn't necessarily catch this upswing in the equity market. So are you concerned at all that people are going to be turning to equities instead of corporates right now?
Well, sure. I actually think they will. So when you look back at the crisis that we had just a couple years ago, folks were really concerned about absolute returns. I mean, they were absolutely wanting the return of their investment and didn't want to take a lot of risk. Now, we're seeing that start to change a little bit, and investors are more concerned about relative returns. And so what we're seeing is that folks who are in money markets earning, again, a basis point or two are considering short-term bond funds, perhaps intermediate funds, and funds that were in the bond market and had a very nice run. Again, over the last 12 months, you've had funds with double-digit returns are looking at the equity markets and are, again, you know, stepping in to higher risk assets. We've seen that in high yield as well, where the cash flows have been fairly strong.
Well, I wanted to ask you about high yield and how that fits into this equation, because if there has been a little bit of talk about the overall corporate bond market getting overheated, there's been more of that talk on the high yield side. So how do you how attractive do you think high yield is versus other corporates right now?
So high yield spreads, the yields available on high yield bonds have certainly come in, and the yields have come down. I don't think it's in a bubble, though. We've gotten that question a lot. For me, when I look at an asset class and you're looking for bubbles, my question is capital being misallocated? So when you look back at the late 90s, early 2000s, and you look at the dot-com problems, you could say capital was being misallocated. When you look at the highly leveraged deals that were done just 2 or 3 years ago, where you had deals being done at 10 or 11 times earnings, or I'm sorry, cash flows, that may have been a misallocation of capital. Today, what we're seeing is that capital is being deployed to refinance their upcoming maturities. So companies are actually doing what I think is the wise thing.
Matt,
go ahead.
I'm afraid we're going to have to leave it there. Thank you very much, Matt Freund of USAA.